Did you know that over 90% of individual investors fail to beat the stock market consistently? According to a study by DALBAR, most investors see returns far lower than the market average. Why does this happen? Simple. Most investors make common, but critical, mistakes that can cost them millions. Even though Warren Buffett, one of the wealthiest people on earth, has built his fortune on principles that anyone can follow, so many investors miss these simple steps. In this video, we're going to uncover the 6 biggest mistakes Buffett sees time and again. From chasing hot stocks to ignoring the power of compound interest, these mistakes are more common than you think. And the good news? You can avoid them with the right mindset and strategy. Stick around to learn how to make smarter decisions with your money, just like Buffett himself. Chapter 1. Chasing hot stocks. The FOMO fallacy. One of the biggest mistakes many investors make is chasing hot stocks just because they're the talk of the town. Whether it's the latest meme stock or the next big thing in tech, FOMO, fear of missing out, can cloud judgment and push people into buying at the peak of hype. Warren Buffett has often said, "Be fearful when others are greedy and greedy when others are fearful." This quote holds a powerful lesson. Hot stocks often burn investors who rush in too quickly. Buffett's strategy, however, is quite different. He doesn't chase trends, instead, he waits for the right opportunity. For Buffett, patience is key. In fact, research shows that FOMO can lead to poor investment decisions. According to a study by the Journal of Financial Economics, investors who chased hot stocks based on media hype often saw lower returns than those who stuck with their long-term strategies. By jumping into overhyped stocks, many miss the fundamentals that make a company truly valuable. It's not about what's trending today, but what will be solid tomorrow. Buffett avoids these trends by sticking to companies he knows and trusts. For example, he has famously invested in Coca-Cola, despite the soda giant's ups and downs. He's always focused on businesses with long-term potential, not short-term excitement. In his book The Essays of Warren Buffett, Lessons for Corporate America, he writes, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. A good way to avoid chasing the wrong stocks is by focusing on value investing. Value investing is about buying companies at a price lower than their intrinsic value. If you're constantly chasing hot stocks, you might miss out on great opportunities to invest in solid companies that are undervalued." Buffett once said, "Price is what you pay. Value is what you get." This distinction is crucial when you're making decisions about where to put your money. You don't need to be part of every stock movement to make money. In fact, Buffett has built his fortune on companies with consistent, stable growth over time. For investors, avoiding the FOMO trap is a smart way to focus on the long term, where the real wealth lies. Chapter 2. Ignoring the power of compound interest. The forgotten magic. One of the most underrated concepts in investing is compound interest. In fact, Buffett himself has described it as the 8th wonder of the world. The idea is simple. The more you invest, the more your money grows exponentially. But the key is time. If you start investing early, you give your money the chance to work for you for decades. According to a study from the National Bureau of Economic Research, starting early in life can dramatically increase an investor's chances of success. Compounding doesn't just increase your returns, it accelerates them. A dollar invested today can become many more dollars in the future, thanks to interest building on top of interest. Buffett is a huge believer in the power of compound interest. His investment in Berkshire Hathaway is a perfect example. Over decades, Berkshire's stock has grown massively, fueled by the magic of compounding. For instance, in 1965, Berkshire Hathaway's book value was just $19 per share. By 2020, it was over $200,000 per share. That's the result of letting compounding do its work. However, many investors miss this golden opportunity by pulling out their investments too soon. A common mistake is trying to time the market, buying and selling based on short-term market fluctuations. But Buffett says, the stock market is designed to transfer money from the active to the patient. Simply put, patience is the secret ingredient to compounding wealth. Here's a simple way to think about compounding. Imagine you invest $1,000 and earn a 10% return each year. In just 10 years, your investment will grow to $2,593. But if you let it sit for 30 years, that $1,000 will turn into $17,449. The longer you invest, the more compound interest works in your favor. It's the snowball effect in action. The biggest mistake here is underestimating the importance of time. The earlier you start, the less money you need to invest to achieve your goals. Buffett himself started investing when he was just 11 years old, and by the time he was in his 30s, his compounding wealth was already noticeable. Chapter 3. The Perils of Overconfidence. When you think you know it all, overconfidence is another trap many investors fall into. It's easy to think you know it all when you've had a few successful trades, but Buffett warns that overconfidence can be dangerous. He says, the most important thing to do if you find yourself in a hole is to stop digging. In other words, don't let ego take control of your decisions. Studies show that overconfident investors tend to make more trades and take on more risk, which usually results in lower returns. A study by DALBAR found that the average investor underperformed the market by nearly 4% annually, primarily due to emotional decisions and overconfidence. In contrast, Buffett's long-term, patient approach has led to far superior returns over the years. Buffett himself is known for his humility. Despite being one of the wealthiest people in the world, he's made it clear that success in investing doesn't come from being a genius. Rather, it comes from having the right temperament and a long-term mindset. As he puts it, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Being overly confident can also lead to overestimating the value of your investments. For example, during the dot-com bubble in the late 1990s, many investors poured money into tech stocks, believing the companies were worth much more than their fundamentals suggested. Buffett famously stayed away from this, saying, "I don't invest in technology because I don't understand it." He chose to stick with businesses he knew and could assess confidently. Being self-aware and acknowledging the limits of your knowledge is one of the best strategies for long-term success. The most successful investors are the ones who are cautious, patient, and willing to admit when they don't have all the answers. That's the approach Buffett takes, and it's worked out pretty well for him. Subscribe now to keep learning Buffett's investment strategies and avoid costly mistakes. Chapter 4. Overlooking the moat. How ignoring a company's competitive advantage costs you. Warren Buffett has always emphasized the importance of a company's moat, the competitive edge that protects a business from its rivals. Companies with a wide moat can fend off competition, generate steady profits, and remain strong for years to come. Many investors, however, fail to see this critical factor, often focusing too much on short-term earnings or flashy products. A great example of a strong moat is Coca-Cola. Buffett's longtime investment in the soda giant wasn't just about the product, it was about the brand's ability to dominate the market. Coca-Cola has spent billions on marketing and built an iconic brand that customers trust. This has allowed them to stay profitable for decades. In the Essays of Warren Buffett, he says, "The secret to successful investing is to find businesses that have a durable competitive advantage. When you ignore the moat, you're setting yourself up for risk." A company without a competitive advantage can easily be overtaken by newer, more innovative competitors. A report by Morningstar revealed that companies with a wide economic moat consistently outperformed those without one. So, before investing, always ask, what is the company's competitive edge, and how sustainable is it? Understanding moats also means recognizing the difference between a temporary advantage and a lasting one. For instance, a tech startup might have a great product, but without a solid moat, it could easily be replaced by the next big thing. Buffett typically avoids such companies, preferring stable industries with predictable profits, like insurance and consumer goods. To avoid this mistake, focus on businesses that have a lasting competitive advantage, whether it's brand recognition, pricing power, or network effects. The stronger the moat, the more secure your investment will be. Chapter 5. Emotional Trading. The silent killer of wealth. Have you ever made an investment decision because you were panicked or excited? Most people do at some point. Emotional trading is a huge mistake that many investors make. Warren Buffett has repeatedly warned that the stock market is designed to transfer money from the active to the patient. In other words, emotional decisions can lead to bad outcomes, and the key is to stay calm and stick to your plan. A study by the CFA Institute found that emotional trading led to underperformance in more than 70% of cases. When the market dips, panic selling can lock in losses. On the flip side, during a market surge, greed can push investors to buy at the top, only to see prices fall shortly after. Buffett's approach is different. He's not swayed by the market's daily movements. He invests in companies for the long term, ignoring short-term fluctuations. Take, for example, the 2008 financial crisis. Many investors sold their stocks in fear as the market dropped, but Buffett remained calm. He made huge investments in companies like Goldman Sachs and General Electric at a time when others were running for the exits. As Buffett says, be fearful when others are greedy and greedy when others are fearful. By staying patient and not reacting to every market movement, Buffett has been able to weather tough times and come out ahead. In fact, over the long term, investors who stick to their strategy and avoid emotional decisions tend to perform better than those who make quick, reactive choices. Studies have shown that those who stay invested through market downturns often recover quicker than those who sell. To avoid emotional trading, develop a clear investing plan and stick to it, no matter what the market does. Buffett's strategy is to buy high-quality companies and hold them for the long term. When you stick to your strategy, you're less likely to make impulsive decisions that can hurt your portfolio. Chapter 6. Underestimating the power of simple businesses. Why complexity isn't always better in today's world. It's tempting to invest in cutting-edge tech startups or complex financial instruments. But Warren Buffett teaches us a different lesson. Simplicity can be the key to long-term success. Buffett has always favored companies that have straightforward business models, ones that he understands deeply. His famous investments in businesses like See's Candies and Duracell are prime examples of this. Buffett once said, "You don't need to be a genius to understand businesses. Just invest in things that are simple and make sense to you." He looks for businesses that are easy to understand, with predictable earnings and a clear value proposition. This strategy minimizes the risks that come with complex business models or industries that are hard to understand. Investors who fall for the allure of complex investments often overlook the potential of simpler companies. A study by Fidelity found that investors who stick to familiar, easy-to-understand investments are more likely to succeed in the long run. The market may reward flashy tech companies, but Buffett believes that consistency, stability, and a simple business model often outperform the more complicated alternatives. For example, Buffett's early investment in Geico was based on a straightforward idea: affordable car insurance. It wasn't complicated, but it made sense, and over time, the company grew into one of the largest insurers in the country. Simple businesses often have fewer moving parts, making them easier to manage and more resilient in tough times. To avoid this mistake, focus on companies with simple, understandable business models that generate steady profits. Don't be swayed by the latest trends or complex investment vehicles. Remember, as Buffett always says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Keeping it simple is often the best way to invest. If you've enjoyed these tips, subscribe now for more on Warren Buffett's timeless investing strategies and avoid costly mistakes.